We have been doing this conference for a number of years, and we never actually bothered to explain to people what we mean by post-seed. As a consequence, a lot of people have explained it for us in a really poor way. Slides. There you go. We are part of the revolution in venture. This isn't, post-seed is not some little tweener round, a gap-filling round. It's actually fulfilling the disruption of venture that started about 10 years ago. Now, I'm sure all of you know about this disruption. The cost of doing a startup went way down. When I did 2 startups in the 90s, I had to raise $5 or $10 million just to get going. You can now do it on 50K, 100K, 500K tops. You can get started. Because of that, there are now 300 micro VC funds. What those of you who weren't in venture 10, 15 years ago may not recognize is it used to be the Series A funds were the first funding source. They've been pushed out of that stage. The inception stage funding is now done by these new seed funds. This is a terrific disruption in venture we hadn't seen for 40 years. There's another part of it that's less well recognized, though. The Series A funds got big. They got really big. They got huge. They got so big, they couldn't do their traditional 4 or 5 million A round. The type of A round I used to have to raise in the 90s, you can't get anymore. They got big, and they want to put a big check in you, like $9, $10, $15 million. That's the second part of the revolution that post-seed is trying to fix. We are the proper sequencing of funding of a company. I'm going to go through and explain this all to you in the next few slides. First of all, these aren't post-seed. A lot of people think a seed extension, seed plus, seed 2, or can anybody explain to me what a pre-A means? I have no idea. That's not post-seed, because these are companies that don't have the metrics to get to a post-seed round. They simply need more seed because they're not far enough along. Could somebody click forward up there? There we go. This is never post-seed. Sorry about the graphics. That is a bridge to nowhere. We have found that a bridge to A is never a post-seed round. There's no landing spot. You're more likely to have a pier into the middle of the lake. So what is post-seed? Post-seed can best be described as an early A round with 3 main characteristics. Capital efficient, it really is the proper sequencing of funding, and it's contrarian to what everybody else thinks should be done. Let me go through all 3 of these things. We have gotten in our heads this is the proper way to fund a company right now. Pre-seed, maybe $125,000 out of an accelerator, a seed round, about $1 million, and then whammo, $8 or $9 or $10 million A round, a big A round. It never used to be like this, by the way, but people accept this as a conventional model. Look what happens when you do this. First of all, when you take that big A round, almost every company I see scales up, hires a lot of people, tries to hit the expectations of their investor. And often they get clogged by doing this. We see right now a lot of companies with the big A have to retrench after or cut back down again, and suddenly they grow faster. A lot of times when you pack too many people in prematurely, you're not efficient about it. But here's the worst part of the big A trap. A lot of these big A rounds, which the A funds want you to take, are 8 on 20, 9 on 21. You're ending up 25, 28, 30 million post on your A round. The normal world of the B round, they want to see a 2x markup. They want to see that the pre-money of the B is twice what the post of the A was. So if you're at 28 post, they want to get in at 56 or 60 million. Now, if you think about it, it's hard enough to get to the big A. Can you really go all the way to get to a 60 million pre in the time frame that money gives you, particularly when you spend it too fast? This is a very hard thing to do, and I don't think it's a proper sequencing of funding. Now, let me give you the contrast. This is what post-seed looks like, these early A rounds. You get your seed, you do the $3 to $4 million post-seed round, and then you try to get to a supersized A round. These are our statistics. I'll show you later that the normal seed to A conversion or graduation rate is really low. Our experience is 65% of our post-seed companies get a next round. In the last 5 we did, they've averaged a $15 million A. So, proper sequencing of funding, you're more likely to get to the big A. you're more prepared for the big A, you're going to raise more in the big A, and your momentum will take you on to a proper B. The third part about being post-seed is contrarian. This matrix is very common in financial circles, right? I see Eric in the audience. I bet you taught me this matrix, Eric, years ago. Basically, you can be right or wrong in your decision, and you can either go with the herd or you can be contrarian. It turns out if you're wrong, it doesn't matter, so take out the bottom half. But if you're right and you go with the herd, what happens? The risk-reward ratio goes the wrong way. That deal gets bid up by everybody, and suddenly you're not going to make the same return. How many of you have heard this mantra that there are about 10 or 15 really good deals every year? If we could just be in most of them, we'll make a lot of money. Have you guys heard this? That's one of the tropes in the venture community. Now, it's based on a study done by Andy Rachleff. Andy Rachleff was one of the founding partners of Benchmark, which I think is one of the greatest venture funds ever. He's one of the great students of the venture industry. 10 years ago, he did a study. He looked over the prior 20 years, 1985 to 2005. How many great companies did we create in the venture industry? Now, he defined great not as a unicorn, a $1 billion valuation. He defined a real company, 100 million of revenue. And he found over 20 years, it averaged about 15 or 20. It averaged. They didn't come every year. We had a bubble in the middle. You guys remember the dot-com bubble? A lot of them came in a very short period of time. Very few of them came before and after. So the idea that you suddenly can find 10 or 15 deals every year, they're going to be great companies, is not consistent with the data. Bullpen is a very data-driven company. Post-seed is very metrics-driven. We have some data now post-Andy Rachleff. Correlation Ventures did a study of the years 2006 to 2015, looked at every unicorn exit over that period, and asked the question, how much money did the investors make? Now remember, these unicorn deals, almost by definition, are herd deals. The consensus stampeded into the deal. The valuations were bid up. People tried to pay up to get into those deals. Okay, let me ask you guys a question. What percent of those investors do you think made even more than 10x? Any ideas? Does anybody think it was more than half? I know I'm leading you down the path. 38% made more than 10x. 62% less than 10x. It's a clear example that even in the defined winners in the last 10 years, most investors didn't make a venture-style return. They ended up getting a 3, 4, 5x return, which is more what a winner looks like for a late-stage growth investor, not a venture investor. So we think we should all be in the contrarian category. In order for our post-seed business to work, we have to be a good picker. How do you become a good picker? Well, part of the revolution in venture is you have data. You think about it. Back in the 90s, when you got a Series A round, you had no data. You hadn't launched the product yet. You had to spend a lot of money to buy servers and write the code and license things. The venture investor had no information other than your pedigree, how good your team was, what was the market like, what was the idea like. In post-seed, we have 18, maybe 24 months of history in the market. You've already been seed funded, you're already in the market. We have data. So post-seed is about data. Part of the revolution is don't try to guess in qualitative measures, look at the real numbers. Product market fit, we all talk about this. We have enough time to get a very confident or non-confident view. Have they hit product market fit? Momentum to hit the next round. In a way, post-seed wants to make sure you're going to hit the 15 supersized, 50 million supersized A round. You have to have enough momentum to confidently get there. We have data that lets us extrapolate. And how do you become contrarian? For the founders, this may sound off, but it's really the right way to put it. The deal's mispriced. We find that a contrarian post-seed deal is maybe one off a consensus deal. Wrong city. First-time founder. Category out of favor. Something slightly off. Maybe the wrong schools you went to. You didn't go to the top schools. Now, before I go any further, for the founders in this room, think about this. Back in the 90s, to raise money, you had to have pedigree. You had to come from the right company. You had to come out of HP. It was hard to break in. In this era of computing, especially when you look at data. You could be from the wrong city, the wrong schools, the wrong background, but your company can prove that you're a quality entrepreneur with a great idea. It's the democratization of venture capital because of the data. Now, mispricing deals, I'll give you an example. A few years ago in San Francisco, there was a passion around valet parking deals, right? Come on, how many people use Lux? Eric does. I love Lux. It's a great idea. The other Eric does. It's really wonderful. It's convenient, it's cheap, but is it a scalable idea? While the venture herd was all looking at Lux and a few other Zerks, we found this deal in Chicago, wrong city. Founder was kind of blue collar, wrong type of founder. The deal he had figured out is, I'm not trying to be convenient that way. Parking garages are like airplanes. They lose money if they can't fill every seat. Like hotels, you got to fill the marginal seat. They became the service for the top garages in the country in the very heart of a city, because they're all over San Francisco, to fill the marginal parking spot. You, as the user, get a very convenient parking garage and a cheaper price. The parking garage owner makes more money. Spot Hero. You guys should all download the app. That's our type of deal. It came out of the little one-offs. It was very well priced, and it's blowing open the market. It's growing so much faster than the other companies. It's a scalable model right now, and it raised its big A round after us. Another part of the revolution is this. We saw the Series A crunch. Has everybody heard about the Series A crunch? I hope so. You guys are not responsive. Come on, Series A crunch? Okay. This is the data of the Series A crunch. This shows the graduation rate C to A. It's a little hard to see in the back, but that peak is 2009, before the current boom even started. It's only 45%. It's been dropping ever since. We said to ourselves, 2010 when we formulated Bullpen, okay, there's going to be an explosion of seed funds. We thought there'd be 100 a day, it's 300. But the A funds aren't changing. They're not investing any faster. They're not doing any more deals. So a huge flood of seed-funded companies are going to hit this sort of turgid wall of Series A firms. Series A crunch. This data should scare people. The current marginal rate of graduation is under 10%. Now, over time, a lot of these companies will get seed 2, seed extensions. They'll muck their way forward, and the graduation rate may go up. I think Tomas Tunguz, which is a terrific guy and a great thinker in venture, thinks that the quality seed deals have about a 25% graduation rate. I tell you, that's not very good. Usually the A to B is 50 and the B to C is 50 and so on. 25 is a bad number. We saw this, and our graduation rate you saw earlier is a lot higher. For those of you who might be in this position of needing a little more seed, this chart is trying to show seed extensions. The orange is what you should really look at. What you're finding is in the first half of 2016, it's become really hard to get that second seed. These are companies that don't quite have the post-seed metrics. It's getting really hard out there. Another reason why, if the whole industry had more post-seed, this ecosystem would be better off. This is a very complex slide. Let me tell you why it's important. The data says you should do post-seed. That's why it's important. It's a better option. The bottom part of this is cumulative seed and angel funding. The post-seed box is when you get to 3.5 to 5 million of cumulative funding. A post-seed round is 2.5 to 4 after maybe $1 million, $1.5 million seed round. What the data shows on the vertical axis is what type of A round are you likely to get. As you can see, as you get into the post-seed range, the follow-on rounds get pretty big. Up at the top, it's 18 million, a supersized A. Let me speak to the founders in the room and wrap this thing up. Let me summarize why you should consider post-A. So first of all, you have more control. You also have more optionality, more likely to get to the supersized round. Let me spend a little time in each of these things. Control. You're a founder and you go to the big A, you're trapped in their expectations. If you miss their expectations, you're in a world of hurt. The venture guys get grumpy. If you want to have more control over your company, you want to be agile, you want to pivot, you want to still have optionality of that sort, don't take the big round. Stay lean. Optionality. There's been a lot of multi-time founders who found that they created a great company and they sold it and didn't make life-changing money. Why? They ended up with a preference stack that got $90, $100, $120 million. And by the time they sold the company, almost all the money went to the venture people with the preferences. We had our first deal where a four-time founder and the first two companies both got bought for good outcomes. They never made life-changing money. In our case, with the lean post-seed round, they had a bluebird offer come in from Salesforce.com and they sold to it. The seed and the post-seed people were very happy. We got 10x and 5x within about 9 months. Nothing wrong with that. The founders made life-changing money. Suddenly they put $20 million in their back pocket instead of getting away with $1 or $2 million in the prior cases. That is huge to you if you want to keep that option open. But the most important thing is you're more likely to get to the supersized day, as I've talked about. Now, for the investors in the audience, if you think about what post-seed does, it makes the venture industry more efficient. A post-seed deal's been well-funded, it has momentum, it's got not just product market fit, it's really figured out a scalable business model. By the time it comes into the big A funds, they can be a lot more confident they should put money in this deal. And they do. The odds are much higher. So I think the whole industry would be better off if we had more post-seed funds out there, and this became the proper sequencing of funding. If you don't mind being a little tongue-in-cheek, this is a way to make venture great again. Thank you.